Now we continue looking at the income statement. This is probably the one that you've seen more times. Sometimes we also call it profit and loss or P&L. It basically summarizes the operating performance of a company over a period, usually a year. Sometimes, you might do an income statement of 6 months or a trimester or a quarter or something like this. But usually we do it for a year. What do we find? So this is usually organized, and at the top usually you see the sales and the revenues. Here it's also important, some companies report gross sales and then net sales, depending if they have a kind of a commission-based business. Sometimes you have this additional element that you need to clarify, or you need to report separately. Now, usually what happens here, the first thing on the sales is that if you are in a project or a project-based company, you also need to decide whether you do the completed sales method or you do this idea of the percentage of completion method. So let's say that if a project is at 10%, then you do the revenues for the 10% of the project, and that's what you report. You need to be consistent if you follow one method or the other. It has implications, as you can imagine, if you are very dynamic, and sometimes you have a lot of projects, sometimes there is no project, and you need to kind of make a decision on that. Again, here probably your accountant or even financial advisor can help on how to do that. Second point, operating costs. Here there are two main concepts that we need to be very clear about. One is the big story about the cost of the products sold. Then we have R&D expenses, and then another big story comes in with the selling and admin expenses. Then we can also have impairments for the intangible assets. This is kind of less common, at least for, again, a startup or a new company. As R&D expenses, here we can have salary, cost of tech components, cost of equipment. Again, here there might be differences depending if you are in Europe or if you are in the US. Selling and admin expenses. This is the big element that we don't allocate sometimes to the cost of the product sold, but it's all the other costs that we might have. So sales and marketing people, salary of executive, advertising, marketing costs, distribution costs, customer service costs, IT costs, traveling, occupancy, and other overheads. This is usually all those things that you need, let's say those secondary activities that you need to keep the business running, but they are not in each of the products or services that you are offering. Meanwhile, the COGS, the cost of the goods, this is goods sold. So this is basically this cost of inventory. This is important, that then the inventory valuation, how is it done? So usually we need to be very clear that it needs to include the parts and raw materials, direct labor costs, manufacturing overhead costs, and again here you need to pick up a method. So if you are using the valuation of the parts and raw materials based on FIFO, LIFO, so first in, first out, last in, first out, average of every time you buy something you average, and then you have an average cost of that raw material, or you do specific identification. So each good that comes in, you know the price, and then this is the cost that you are allocating. This is, again, it depends on what type of raw materials or goods you're buying. Second, other elements that are important are all the aspects related to the earning before income and taxes. So this comes at the end. So we have the sales and revenue, then all the different types of operating costs. In the middle, then you can have this more, even if you want to report operating income or some other sub-level aspects. But then at the end, we finish with the earnings before income taxes. Then we get the taxes, and then we finally have the net income or net earnings. Some companies even report this as comprehensive income, and then we can start developing all those more specific ratios like earnings per common share or other smaller elements. Here we will be moving, as we did also in the last part, to the e-learn to look for the kind of more visual videos that we have to support this part of the class. Let's continue and let's now try to see basically one of the statements that maybe you are not that used to it, but it's equally important and useful for us to understand the business and the way it works. This is the statement of cash flows. Basically three statements. One is cash flow from operations, second is cash flow from investment activities, third one, cash flow from financing activities. Each of those statements will also generate this net cash, so basically the change that has happened in that statement. The aggregation of all of them give us the overall net cash generation of the company. And this is a quite useful information. We do that, each of those statements is generated by analyzing a specific cash flow that happens in the company. The first one, as you can imagine, is the most important, is the core activities of the company. This is we call cash flow from operating activities. This is the day-to-day things, the things that our business, like define our business. So how do we do that? We move from the bottom of the income statement, the net income, and then we need to adjust it. And we need to adjust it with two different type of elements. One, non-cash expenditures and income. So all the depreciations of the assets that we might have, amortizations and other aspects. Second, by the changes that there might have been on the levels of current assets or current liabilities. So we don't want these changes in working capital to impact. So what we want to be able to see is what would be the raw capacity of generation of cash that this company has. This means that we don't care if they just have, let's say, very expensive assets that are being depreciated and they are maybe affecting their capacity to generate profits. So we just want to see the capacity to generate cash that this organization has. So it's a bit regardless of their situation of their assets, what is their raw capacity. That's what we will be getting here. Second aspect, cash flow from investing activities. Here what we are getting is what is happening with this company as they use the cash that they have to invest in other things that might not be their business. So maybe they invest in intangible assets, they have position in companies, and we need to take that into account. Maybe the company suddenly starts using a lot of their cash that they generate to invest in other businesses. This might be a concern for some investors, but it might be actually generating extra cash if the proceeds are much higher than, for example, the original purchase prices that they might be having. So maybe that's a good way for them to generate extra cash from an investment they did long term ago. And last element, the cash flow from financing activities. Here what we have is additional cash that is coming into the company, but actually is not related to specific investments, is not related to their day-to-day operations, but is actually related to stock that they are selling, or maybe they are repaying debt. So their own financing structure might be a source of cash generation. Just imagine a company that, for example, might be selling a stock, and they are suddenly getting cash, and we can see that they have a better cash position that they had a year ago, but they have achieved that not through the generation of day-to-day operations, running their business better, but they have achieved that because they have been selling their own stock, or maybe issuing new stock. So that's a kind of a thing we want to know, and we want to know what are the different sources. Here again, you will have a break, and then you can look at the e-learn space where you have an additional video to watch. And here is the moment that we take a break and we go into our workshop that we will be using the simulation game that the colleagues from MIT Sloan have developed called Clean Start.